Hello, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. With this video, I'm going to explain how to utilize PE versus interest rate graph that's available to premium subscribers. It's one of the other red graphs that premium subscribers have access to. With my first example here, I'm going to look at Consolidated Edison, and I want you to notice that this is a very low growth utility stock, only growing at 1.9%. You can see periods of low valuation. And I also want to really focus on the fact that the stock was technically undervalued back in the beginning of 2002 here when the PE ratio was below the orange line, which is a PE ratio of 15. It's kind of small here. Let me see if I can get it up. But anyway, you can see the PE's flashing around 12 there. Now, when I go down to the PE to interest rate graphs, you get a very interesting analysis. In theory, what you have here, first of all, is the 10-year note. So if you just run your mouse along this red line, it will tell you what the 10-year Treasury note was paying on such a date. And here we have March of 31st of 2004. Interest rates were 4.66. Now you can see the interest rates have steadily dropped. There's always some volatility. They began rising again in 2016. Now if I add back the fiscal year-end PE ratios, if you just point to the blue dots here, you'll see that the blue dots tell you what the company's fiscal year-end PE ratio was. So for example, right here at December 31st, 2011, Consolidated Edison was trading at a PE ratio of 17.4. At year-end 2017, it was trading at a PE of 20.6. This actually represents how this graph is supposed to work. As interest rates are dropping, when you have this period here, you have a period where PE ratios should rise. The idea being that when interest rates are dropping, bonds and other fixed income instruments get less competitive. And a utility stock is kind of a quasi-fixed income instrument like Con Ed. It's low growth, higher yield, which has some of the characteristics of a bond. But then as interest rates kept dropping here, you can see that the PE ratio kept increasing. And that's kind of how this was designed originally, on the notion that there would be an inverse relationship between interest rates and PE ratios. To say that in English, if interest rates were dropping, stock PE ratios would tend to rise, and if rates were rising, PE ratios would tend to drop, because at higher rates, bonds are more competitive than they are at lower rates, or more competitive with stocks, that is. Now with my second example, I'm going to Microsoft, and I want to point out that back in the irrational exuberant period, in contrast to what we saw before with Con Ed, you see very high valuations on Microsoft and other tech stocks as we came into the calendar year 2000. And then, of course, their prices fell precipitously and then were overvalued again. So if I go to the price to sales graph of Microsoft, you get the exact opposite of what you should expect. As interest rates were dropping during this period of time, the PE ratio of Microsoft was dropping with it. But the point is this: the valuations of Microsoft were abnormally high back in this 98, 99, and 2000 period of time. So even though interest rates were dropping and falling from a high here of 6, all the way down to a interest rate of 1.57 on the 10-year Treasury bond by 2012, you had both Microsoft's PE ratio and interest rates falling simultaneously. Now, more recently, as Microsoft became, I'll say, relatively attractively valued back in this area here coming out of the Great Recession, you started to see this relationship working. As interest rates fell, Microsoft's PE began to increase. But once again, it increased far beyond what interest rates would indicate. So even though there is, I think, a strong relationship between higher rates and lower PE ratios and vice versa, that relationship is also impacted by other things such as valuation. With tech stocks so overvalued back in the 1999, 98, 2000 era, or i.e. known as the irrational exuberant area, even though we went through a long extended period of dropping rates, Microsoft's PE ratios continued to drop because they were in essence reverting to the mean evaluation. So this is a nice metric, and it can work, and it can give you some good insights. For example, one of the asset classes that people tend to be real concerned about with interest rates would be obviously real estate investment trusts, or REITs. So when you look at realty income, you see a low valuation back here in 1999 and 2000, kind of like we did with Con Ed. And then you see real high valuations in 2016 and 17, which of course have been reverting to the mean. But when you look at the P equals interest rates graph on this REIT, it works exactly like it was theoretically supposed to in terms of the direction. As interest rates were real high, the PE ratio of the REIT was lower, and as interest rates continued to drop, year-end PE ratios tended to have an upward bias. And this is the way it's supposed to work, but there's also a lot of other things with REITs. Anyway, that's what the PE interest rate graph is, just simply showing you interest rates based on the 10-year Treasury note on the one scale, on the burgundy scale here, or which is your left scale, which is simply interest rates. And then we simply plot closing PE ratios for each year end with the blue line so that you can see what direction the PEs were going to. And in this case, you see dropping interest rates and rising PE ratios as you would expect. But in other examples like Microsoft, you saw both moving in tandem. The point is, don't fall prey to some of these little cliches or little adages. You know, interest rates do and will have an impact on stock prices. Ceteris paribus, all things remaining constant. But if you are getting dropping rates when valuations were real high, there was no real reason for valuations to go up. Interest rates were dropping, but valuations were already high, so they weren't going to go any higher. This has been Chuck Carnival saying, I hope you enjoyed this PE versus interest rates graph and understand it better now. Thanks for watching.